Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
481%. I mean, that is the number that matters today, Friday, January 30th, 2026. If you were looking at your terminal this morning, you saw Elong Power Holding Limited, ticker ELPW, just absolutely tear the roof off. We're talking about a stock that hit a 52-week low of, 28 cents just 8 days ago, and then it suddenly explodes in one session. The volume was huge. The volatility was frankly insane. It woke up the whole microcap space.
It was violent, I'll give you that. But let's be, very precise about what we're actually looking at here. This is a microcap Chinese battery manufacturer that has been, for all intents and purposes, completely left for dead by the market. So the central question isn't just why is it up today, it's whether this is a real resurrection of a viable business or if it's the last convulsive gasp of a dying stock before it flatlines to zero. You see a rocket ship, I see a classic bull trap.
I just see it differently. I think we're looking at a classic, a very aggressive repricing event. My stance is pretty simple. Elong Power has successfully navigated a huge capital restructuring. They did the 16-for-1 reverse split back on December 26. They got the F1 effective for that $9.2 million raise, and now the market is waking up to the fact that this isn't a bankruptcy candidate anymore. This is a company with a clean balance sheet, a fresh cash injection, and a backlog that simply doesn't make sense for a market cap under $10 million. The market was pricing in death. Today, it started pricing in survival.
And I'm taking the position that ELPW is a distressed asset caught in a death spiral. And anyone chasing this 400% plus move is just walking straight into a buzzsaw. When you look at the fundamentals, negligible gap revenue, these non-binding headline deals, and a macro environment that is just openly hostile to speculative Chinese assets, this rally looks purely mechanical. It's a dead cat bounce, plain and simple. And it's driven by low float dynamics, not by any real business success. You don't gain 400% in a day because the business got 400% better overnight. You do it because the stock's plumbing's broken.
Well, then let's test that theory, because the market seems to disagree with you pretty strongly today. And usually, price leads the narrative.
The market is emotional. Our job is to be analytical. And I want to start by dissecting your whole clean slate argument. You mentioned the restructuring. Okay, let's look at the history. This stock hit an all-time high of $184 back in October of 2024. Today, even with this massive green candle, it's still down 99.8% from those highs. That is a monumental destruction of value. That's not just a bad quarter, that is a complete and total rejection of the original SPAC valuation.
That's exactly my point. The history is irrelevant to the trade right now. The market is mispricing the reset. The slate has been wiped clean. The old shareholders, yes, they took a massive, massive hit. They're the bag holders of the past. But we need to look at the assets, the tech, and the order book as they stand today. The threat of delisting is gone. They fixed the bid price deficiency. They fixed the filing deficiency. That uncertainty discount, which was probably 90% of the price depression, is evaporating as we speak.
You're glossing over what it cost to fix it, though. That 16-for-1 reverse split wasn't just some cosmetic change. It was a desperate move to stay listed on the NASDAQ. And the $9.2 million raise, that came with enormous dilution. You can't just say the slate is clean when the equity structure has been completely re-engineered to benefit new money at the expense of everyone who was there before. But fine, let's look at the valuation. Right now, we're looking at a market cap somewhere between, 1.8 and maybe $8 million, depending on the minute.
Which is exactly why the asymmetry is so compelling. Compare that, say, $1.8 million valuation to the order book. They have a signed energy storage contract with Ningbo Hanan worth 480 million RMB. That's $67.6 million US dollars. You have a company valued at maybe $5 million sitting on a contract worth more than 10 times that. Even if you discount it heavily for execution risk, let's say you only believe 20% of it will happen, the math is still broken to the upside. And this isn't vaporware. They're making 60 fast-charging batteries.
Okay, hold on. Let's define that for a second because these technical terms get thrown around way too loosely. When you say 6C, you're talking about the C rate, right? the measure of how fast a battery is discharged relative to its max capacity. So 1C is a 1-hour charge.
Exactly. And 6C means 10 minutes, a full charge in 10 minutes. For a heavy mining truck or industrial transport, that is the difference between a profitable shift and a wasted one. I mean, if you're running a mining operation in Inner Mongolia, you can't have a truck sitting at a charger for 2 hours. You need it backhauling ore. Their liquid-cooled, high-weight battery solves that specific bottleneck. That's a real, tangible competitive advantage.
The physics are impressive, I'll grant you that, but I just don't buy the valuation argument because it completely ignores the reality of their financials. You cite the $67 million contract, but let's look at the delivery gap. The latest data shows revenue of $235,000, not millions, thousands. And to generate that $235,000, they spent $2.59 million in cost of revenue.
They're in the ramp-up phase. You expect burn at the beginning of a manufacturing pivot.
There's burn, and then there's a bonfire. They are in a gross profit deficit. They're losing money on every single unit they ship before they even pay for R&D or overhead. That tells me the unit economics are fundamentally broken. You can have $1 billion in your backlog, but if it costs you $2 billion to fulfill it, you don't have a business. You have a very expensive philanthropic endeavor.
But you're looking backward at the initial R&D spend. The $9.2 million buys them the runway to fix those unit economics. And frankly, the price action today tells me that someone with deep pockets agrees with me. You just don't get a 481% move on retail hype alone. This kind of volume requires institutions.
Actually, you do get this kind of move without belief if the market's plumbing is broken. Let's talk about that price action. You call it a repricing. I call it market microstructure mechanics. This is where we need to get into the weeds a bit.
Let's do it. Because I think the data backs up a squeeze thesis. If you look at the FINRA data for late January, the off-exchange short volume ratio has been hovering between 50 and 60%.
And for the listeners, let's just clarify. Off-exchange means trades happening in dark pools, private exchanges where big institutional orders are matched away from the public markets.
Right. And a ratio of 60% is incredibly high. It means over half the selling volume is happening in the dark. That usually means smart money is trying to hide their positions. But look at the borrow fees. To short this stock right now, to bet against it, you are paying between 31 and 41% in annualized fees. That is wildly expensive. It tells you the shares are scarce. Post-split, the flow is only about 3.8 million shares. It's a coiled spring. The shorts are trapped in a tiny room with a very small door. And today, the bulls just lit that room on fire.
That's a compelling story. But have you looked at who is actually in the room? The institutional ownership updates from late 2025. Who are the new players? Renaissance Technologies? Jane Street? XTX Topco?
Smart money. Some of the most successful funds on the planet.
Algorithmic money. These aren't long-term value guys betting on lithium manganese oxide chemistry. These are high-frequency trading firms. They're volatility harvesting. They see a wide bid-ask spread on a distressed microcap, and they're just scalping the swings. They aren't betting on Elong's success, they're betting on the stock's chaos. And here's the real kicker. The visible short interest is only about 9,000 shares.
Which makes the official short squeeze score look low, sure.
It makes it look non-existent. But you just said the off-exchange short volume is 60%. That means the real bearish betting is happening in the dark pools. The sophisticated players are betting against this company, but they're hiding it. Today's 481% spike, that's just a liquidity event. It's the algorithms flushing out the order book. It doesn't mean the company is saved. It just means the stock is incredibly thin.
I see why you'd think that, but I'd frame it differently. High dark pool short volume often comes right before a massive squeeze because that hidden pressure eventually has to cover. If ELPW drops a single press release confirming a payment on that Nanjing contract, those dark pool shorts are instantly underwater. They have to buy to cover, whether they're algos or humans. And with a float this small, that buying pressure sends the stock parabolic. That 481% we saw today, I think that could just be the opening act.
If they drop the PR. That brings us right back to the business itself. You seem confident in their valuation next to peers, but I have a hard time finding a peer that looks this broken.
I'm confident in the relative value. Look at the new energy space. Fuel cell energy. Market cap over $433 million. Hyliion, $369 million. Even SkyX Platforms is over $300 million.
And those companies have their own problems, but they have scale, they have infrastructure. Fuel Cell has real revenue in the tens of millions.
But Everlong is trading at a tiny fraction of that $1.8 to maybe $13 million. Even if Evlong Power only trades at 1/10 of Fuel Cell's valuation, it's a multi-bagger from here. The forward price to sales is 7.4, which is perfectly reasonable for a high-growth battery company if they execute the backlog. You're paying pennies on the dollar for the potential of that backlog.
That word if is doing a lot of heavy lifting in that sentence. You can't compare ELPW to Hyliion when ELPW has negative shareholders' equity. I mean, their liabilities are bigger than their assets. The standard valuation metrics just don't work in that scenario. And again, I keep coming back to this delivery gap. They announced that $67 million deal in May 2024. It is now January 2026. Where's the revenue? That gap between the headline number and the gap revenue is where investors go to die.
Industrial contracts take time to ramp up, especially with energy storage systems. You need grid interconnection approvals. You can't just plug these things in. But let's pivot to the growth story, because it's not just the domestic market. The Indonesia strategy is what really changes the game for me. This is their blue ocean.
Ah, yes, the billion-dollar headline. I was waiting for this one.
It's a huge framework, a strategic cooperation with Indonesia's BPKN. The goal is $1 billion in investment for solar plus storage systems. This is Elong Power pivoting away from the hyper-competitive Chinese EV market, where margins are razor-thin, to Southeast Asia, where there's a desperate need for off-grid power. Their LFP lithium iron phosphate batteries are perfect for this because of the high cycle life and thermal stability.
I'm sorry, I have to stop you there. Did you actually read the fine print of that announcement?
I did.
It explicitly states the agreement is non-binding, it guarantees zero purchase orders, it's a framework. In the world of distressed Chinese microcaps, a non-binding framework is basically just a press release designed to pump the stock right before they need to raise more capital. It's marketing, it's not revenue.
That is an incredibly cynical view. BPKN is a government body. This isn't some handshake with a shell company. This is a sovereign-level strategy.
But look at the timing of it. China is staring down a subsidy cliff. The EV trade-in subsidies, 62.5 billion RMB worth, are fading out this year. Domestic competition is crushing them. Yutong Bus, their main partner, is great, but that market is saturated. So of course they're desperate for a narrative outside of China. The Indonesia deal feels like a survival tactic to distract from the fact that they're losing the war at home. Until I see a purchase order with a wire transfer attached to it, that $1 billion is imaginary.
I think you're underestimating the geopolitical angle here. And this brings us right to the macro environment. You mentioned the subsidies, but look at what's happening in the U.S. This is exactly why non-U.S. markets are so critical right now.
Okay, let's bring up the Polymarket data because this is crucial for anyone thinking of holding this stock over the weekend. I was looking at the prediction markets this morning.
And what are the odds telling us?
We're looking at a U.S. government shutdown probability of over 80% for tomorrow, January 31st. The whole thing is grinding to a halt. In a shutdown scenario, liquidity in microcaps just evaporates. It becomes a total risk-off environment. Investors dump the speculative stuff first.
I disagree with that interpretation. I think domestic U.S. chaos actually favors non-correlated assets. If the U.S. market is paralyzed by a shutdown, money looks for idiosyncratic plays, things that move to their own beat. And ELPW is definitely idiosyncratic. It doesn't move with the S&P. It moves with its own news cycle.
It's not just market sentiment. It's the SEC. If the government shuts down, SEC processing slows to a crawl. ELPW is a foreign private issuer. They have ongoing compliance needs, filings, future raises. If the SEC is running on a skeleton crew, this company could get trapped in regulatory limbo. They might not be able to file the paperwork they need to access more cash.
That's a fair point on the SEC, but the business operations are in China and Indonesia.
But the stock is in New York. And let's not forget the tariff risk. Polymarket is showing a 75% probability of maintained or expanded tariffs on Chinese goods. That effectively walls off the U.S. market for their products.
But that's exactly why the Indonesia deal matters. They aren't trying to sell into the U.S., they're pivoting to the global south. Indonesia, the Middle East, that's where the growth is. The U.S. tariffs are already priced in. The U.S. shutdown is noise. The real business is in Asia, and their partners, Yutong Bus, Shanxi Tongli, these are domestic giants in China. They provide a safety net that has nothing to do with Washington politics. Yutong isn't going to stop buying batteries because the U.S. government shut down.
A safety net? Let's talk about safety and governance then, because while you see a founder-led turnaround, I see a governance trap.
You mean the voting rights change?
I do. Just this month, January 2026, shareholders approved a change to Class B shares. The voting rights went from 50 votes per share to 200 votes per share. CEO Xiaodan Lu now has absolute, unchallengeable control over the company.
That's founder mode. Look, when you're executing a turnaround this difficult, you can't have short-term activists or hostile acquirers disrupting the plan. She needs the runway to execute the 6C technology roadmap without looking over her shoulder every quarter. This allows for long-term thinking.
Or she's just entrenching herself so she can't be removed despite presiding over a 99% destruction of value. This dual-class structure completely disenfranchises the common shareholder. You're buying a ticket for a ride where you have zero say in where the bus is going. And given the dilution we just saw, that bus is getting very crowded.
But if the bus is going to a 10x valuation, I don't really care if I'm driving. I just want a seat. The market rewards conviction.
That is a very big if, and it relies entirely on trusting a management team that has presided over a total collapse in the share price.
Okay, let's bring this to a close. We've looked at the massive price spike, the dark pool data, the contract backlog, the macro risks. Where do you ultimately land on this?
I come at it from a position of risk management. I'll acknowledge the technology is interesting, theoretically, but ELPW is a governance trap with a completely broken balance sheet. This recent price spike, that 481% move, it's a technical squeeze in a dark pool-dominated stock. It's mechanics, not fundamentals. The billion-dollar Indonesia deal is just paper for now. And with the U.S. government shutdown looming and China's subsidies fading, the headwinds are just gale force. I think this is a volatility trap, and retail investors are going to get hurt when the algorithms pull the plug.
And I see why you think that, but I'm looking at the asymmetry. The reset button has been pressed. The split and the capital raise bought them survival. The market is currently valuing this company as if it's going bankrupt, and it's completely ignoring the $67 million backlog and the strategic partnerships. If they recognize even a fraction of that revenue, the re-rating is going to be violent to the upside. So for the risk tolerant, the discrepancy between let's say, $2 million market cap and the industrial reality offers a very rare opportunity.
It's definitely rare. Whether it's an opportunity or a cliff is the real question.
I think the moment of truth will be the next quarterly earnings report. We need to see if any of that Nanjing contract revenue actually hits the books.
I agree. And in the meantime, I'd encourage listeners to go dig into that off-exchange short volume data for themselves. Don't just look at the ticker, look at where the trades are actually executing. That tells you what the big players are really doing.
That's where the real story is.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.